15,000 intermodal containers entered Chapter 11 bankruptcy protection on January 12, 2026. These containers move freight through every major port and rail ramp in America. STG Logistics filed for bankruptcy with over $1 billion in debt. The company handles cargo for products on store shelves across the country, and it operates the largest container freight station network in the United States. The filing represents the largest trucking bankruptcy of 2026. The case involves reorganization, not shutdown. The restructuring will eliminate 91% of the company's debt, while operations will continue. A $710 million acquisition, completed in March 2022, became a billion-dollar bankruptcy 4 years later. STG Logistics has been moving freight for 41 years. The company started in 1985 as St. George Warehouse in South Kearney, New Jersey, running container freight stations at the Port of New York and New Jersey. For 3 decades, it built a reputation in warehousing and logistics. In July 2016, Wind Point Partners acquired the company and executed 8 acquisitions over the next 3 years. STG quadrupled in size. By 2022, private equity wanted more growth. The pandemic had created a freight boom with rates at record highs. The market appeared sustainable. In March 2022, STG Logistics paid $710 million in cash to buy XPO Logistics intermodal division. The deal added 11,000 containers, 2,200 tractors, 5,200 chassis, and 48 locations across North America. The acquisition was financed with substantial debt. XPO's intermodal unit had generated $1.2 billion in revenue the year before. STG projected the combined company would exceed $1.7 billion in annual revenue. Management described it as a game-changing acquisition that would create capabilities no competitor could match. The deal closed in March 2022. That was when the Great Freight Recession began. STG had acquired assets at the absolute peak of the freight market, with a massive debt load financed at a 10 times EBITDA multiple. The market collapsed immediately after closing. Freight volumes fell, spot rates began a 2-year decline, and by mid-2025 rates had dropped from over $3 per mile to under $2.30 per mile. That represents a 25% decline, while operating costs remained elevated. The company that projected $1.7 billion in revenue generated $1.6 billion in 2024. Revenue declined $65 million between 2023 and 2024. Projections showed another $162 million decline between 2024 and 2025, totaling $227 million in lost revenue over 2 years. In the second quarter of 2024, adjusted earnings before interest, taxes, depreciation, and amortization fell 95% year over year. By January 2026, STG Logistics filed Chapter 11 bankruptcy in New Jersey with $1.2 billion in debt and only $34 million in cash. Bankruptcy. The acquisition timing created the fundamental problem, but 3 additional factors made survival impossible. Survival. Floating rate debt during the fastest interest rate increases in decades compounded the damage. STG financed the XPO acquisition with loans tied to floating rates. When the Federal Reserve began hiking rates in 2022, borrowing costs surged. The company carried massive debt acquired at the market peak, while watching interest expenses climb as revenue fell. Each Federal Reserve rate increase deepened the losses. Interest insurance costs rising 48% between 2023 and 2025 added pressure. The trucking industry faced record insurance rate increases for 5 consecutive years. Premiums reached an all-time high of $10.20 per mile in 2024. The first quarter of 2025 saw another 5.8% year-over-year increase. Nuclear verdicts exceeding $10 million forced insurance companies to raise rates. STG operated 3,000 tractors with owner-operators and employed 2,150 drivers. Insurance became one of the largest cost increases while revenues declined. Insurance, the owner-operator classification structure, created legal exposure. STG used independent contractors for 100% of its dray business, but controlled their schedules, work assignments, and compensation through non-negotiable contracts. The arrangement did not meet legal standards for independent contractor status. Legal in August 2024, STG settled a California class action lawsuit for $4.2 million and ended its independent contractor model in California. The lawsuit alleged misclassification of owner-operators who should have been classified as employees. Similar claims remained pending in New Jersey. The company had inherited these practices from XPO Logistics, which had already settled multiple misclassification lawsuits for over $30 million. Settlement costs, insurance increases, and rising interest rates drained cash, while the freight recession suppressed revenue. The company eliminated 242 employees between May and July 2025 to generate $22 million in annual savings. Management renegotiated equipment leases to free up $30 million in liquidity and projected $68 million in total cost savings. The measures proved insufficient. In October 2024, STG attempted a major refinancing. The transaction generated $327 million in incremental value, including $137 million in new loans and $50 million in new equity from private equity sponsors. Over 93% of lenders supported the deal. Two lenders holding $56 million in loans declined to participate. The structure left them with claims worth an estimated 15% recovery, while participating lenders achieved 95% recovery. 9 days before the bankruptcy filing, a New York court ruled the minority lenders had properly alleged a calculated plot to deprive them of their contractual rights. The company had run out of alternatives. STG Logistics represents one case in an industry-wide contraction. The Great Freight Recession entered its fourth year with no clear end. The downturn began in April 2022 when freight volumes fell as pandemic-driven consumer spending on goods shifted back to services. Inventory accumulated, retail demand cooled, and manufacturing activity slowed. Industry forecasts predicted recovery in 2025. Recovery did not materialize. The industry has recorded 13 consecutive quarters of weak demand. Spot rates collapsed, while contract rates remained suppressed. Excess capacity flooded the market as thousands of new carriers who entered during the pandemic boom competed for fewer loads. Shippers gained bargaining power. Small carriers relying on spot markets operated at losses to maintain some revenue. Every month in 2024 saw a net decrease in for-hire trucking companies. Carrier operating authority revocations exceeded new entrants at historic levels. Equipment repossessions increased 40% year over year. December 2024 recorded the largest monthly net exit of carriers since the previous April. The first half of 2025 showed net revocations 16% higher than the same period in 2024. Industry analysts describe this as one of the longest freight downturns in trucking history, defined not by severity, but by duration. The pattern represents sustained decline rather than sudden collapse. Industry executives acknowledge surprise at the recession's length. The Owner-Operator Independent Drivers Association characterizes it as potentially the most prolonged recession in the sector's history. Forecasts predicting recovery have consistently proven incorrect. Conditions continued deteriorating. In January 2025, tariffs on imported goods ranged between 10% and 145% depending on country of origin. Import volumes were forecast to decline 14% year over year in the second half of 2025. STG's volume fell 7% in 2025 compared to 2024, largely from tariff-driven import declines. Approximately 50% of freight entering the Port of Los Angeles and Long Beach originates from China. That trade volume is declining. Intermodal and port drayage carriers continue seeing volume reductions. Private fleets now handle 70% of outbound shipments in America, an all-time high. Large shippers are bringing trucking operations in-house, rather than contracting with carriers. Market consolidation means the four largest third-party logistics providers control approximately 85% of total market share. Small and mid-size carriers face intense price competition from market oversaturation, while operating costs continue rising. However, profitability collapsed from approximately $1 per mile in 2021 to 3 cents per mile by 2023, while operating costs remained around 40 cents per mile. Many owner-operators run loads at losses to maintain business operations. The freight recession forced Standard Forwarding Freight, a 91-year-old LTL carrier, to close on December 29th without warning. It is closing 10 Roads Express, a postal service trucking contractor, ending operations. It pushed Yellow Corporation into liquidation in 2023, eliminating 30,000 jobs. Now it has forced STG Logistics into Chapter 11 with over $1 billion in debt. The pattern extends beyond individual companies. Carriers still operating are those able to sustain years of losses while waiting for recovery that has not arrived. STG Logistics plans to continue operations. The bankruptcy represents reorganization rather than liquidation. The company secured $150 million in new financing. Operations continue without interruption. Employees receive regular pay. Customer service continues. 1,170 workers retain employment. 15,000 containers continue moving freight. The debt structure undergoes transformation. 91% of nearly $1 billion in obligations will be eliminated. New money lenders will control 57.5% of the reorganized company. First-out term lenders receive 40% equity plus new debt. Second-out lenders receive 2.5%. Third-out lenders and general unsecured creditors receive nothing. Union Pacific absorbs a loss of $13.4 million. Other creditors holding smaller claims lose their full investment. The minority lenders who rejected the October refinancing were correct that the transaction transferred value away from their positions. The bankruptcy court approved the structure. STG expects to emerge from bankruptcy by mid-May 2026 with restructured obligations and reduced interest expenses. The private equity sponsors who acquired the company in 2016 and executed the $710 million XPO acquisition will maintain ownership stakes through the new equity structure. The management team that made the acquisition decision remains in position. The freight recession continues. Analysts project meaningful recovery may not occur until 2027, representing 5 years of sustained downturn. Carriers that survived are reducing capacity, cutting staff, and deferring equipment purchases. New truck orders run 22% behind last year's pace. Used truck inventories reached record levels. Equipment purchases make no economic sense in markets where freight movement generates losses. For end consumers, this creates continued pressure on shipping costs that eventually appears in product pricing. When carriers operate on minimal margins or losses, they cannot absorb cost increases. Insurance, up 48%, gets passed through to pricing. Tariffs on imported goods transfer to pricing. Higher interest on equipment financing flows through to rates. Regulatory compliance costs move to customer charges. Companies surviving this freight recession will be larger, more consolidated, and operating with reduced competition. That structure provides increased pricing power when demand eventually returns. Small owner-operators who survive will face markets dominated by mega-carriers with stronger balance sheets and better economies of scale. STG Logistics filed bankruptcy with $1.2 billion in debt. 4 years after paying $710 million for an acquisition that closed the same month the freight market collapsed. The company will reorganize and maintain operations. The private equity sponsors will retain positions in the restructured entity. The creditors absorb the financial losses. The Great Freight Recession that began in March 2022 continues in February 2026 with no recovery established.